Today, we're diving into a fascinating showdown in the world of digital advertising. It's a real David versus Goliath story. In one corner, you have the absolute titans, the household names we all know. And in the other, you've got this scrappy, AI-powered challenger that's been quietly changing the entire game. Let's get into it. Welcome back to Talking Business as Usual. We've got a lot to unpack today, so let's jump right in. All right, here's the game plan. First, we'll sketch out the new ad landscape. Then, we'll look at the latest report cards from big tech. After that, we introduce the challenger, AppLovin, and put it head-to-head with Meta. And finally, we'll wrap it all up with an investment thesis. Okay, let's kick things off by setting the stage. Because to really get what's happening, you have to understand that in digital ads, not everyone is playing the same game. What's really key to understand is that each platform measures success completely differently. For Google, it's all about the cost per click. Simple. How much does it cost to get someone to click? For a retailer like Amazon, it's all about return on ad spend, the holy grail, right? You put $1 in, how many dollars do you get back? For Netflix, it's about keeping you glued to the screen. So they live and die by the video completion rate. And for social media, well, it's the name of the game, engagement. So now that we know how they're keeping score, let's look at the actual report cards. How did the big players really do last quarter? This gives us a great snapshot of who's hot and who's not. First up, the king, Google, $63.1 billion in a single quarter. I mean, just let that number sink in. That's up a massive 17%, and a lot of that is thanks to their new AI making their search ads smarter than ever. But check this out. Meta is on an absolute tear, $58 billion, growing at a blistering 24%. This is because they've really transformed from just a social network into this unbelievable AI recommendation engine. It's less about you finding things and more about things finding you. And then there's the giant that's fully woken up, Amazon. Their ad business is on fire, up 23% to over $21 billion. And why wouldn't it be? They have the ultimate unfair advantage. It's the shortest distance in the world from, ooh, I want that, to your package has shipped. And finally, let's not sleep on the new kid on the ad block, Netflix. Yeah, the dollar amount is still smaller, but the growth, it's explosive. 2.5 times bigger in 2025. And it looks like they're going to double it again next year. They're becoming a powerhouse. Okay, so the giants are all doing incredibly well. They're growing, they're printing money, and they dominate the headlines. But this brings up a really crucial question, especially if you're an advertiser. With all this incredible scale, where do you actually find the best bang for your buck? Forget size for a second. Where is the real, measurable efficiency? Well, this is where our challenger steps into the ring. So let's talk about AppLovin. At its heart, it's a super specialized platform built for the mobile app universe. And its secret weapon is this AI called AXON 2.0. And this AI is frankly legendary at doing one thing, predicting exactly how much a user is worth and ensuring advertisers get their money back and then some. Here is probably the best way to think about it. You know how Meta has its walled garden, Facebook, Instagram, all that? They control everything inside. Well, AppLovin has basically built that same level of AI firepower for everyone outside that wall. They're bringing Meta-level tech to the rest of the app world. Now that is a really bold claim. So let's not just take their word for it. Let's put it to the test. We're going to see what happens when you spend $10,000 on Meta versus $10,000 on AppLovin. Let's do a little showdown. All right, let's break down the numbers. You can see right away AppLovin's a little bit cheaper just to get your ad in front of eyeballs. But that's not the real story. Look at the click-through rates. It's more than double. And that difference flows right to the bottom line, an estimated $32,000 in revenue, versus just $22,000 from the exact same spend on Meta. And this right here, this is the number that every performance marketer dreams about, a 3.2x return on ad spend. Let me be perfectly clear what that means. For every dollar an advertiser puts in, they get $3.20 back. It's incredibly profitable, and even more importantly, it's predictable, and predictability is everything. So how in the world are they doing this? Well, it all comes down to the AI's diet, the data it's trained on. Meta's AI knows what you like and who you follow. It's a social genius. AppLovin's AI, on the other hand, is trained on how you play and what you buy inside of apps. And it turns out, how you play is a way better predictor of what you'll pay for. Okay, let's bring it all home. We've seen the market, we've seen the big players, and we've seen the cold, hard data from our showdown. So what does this all mean if you're looking at this as an investment? The bull case, the argument for AppLovin, is pretty darn compelling. You're talking about revenue growth north of 40%. You've got these beautiful, high-tech software margins around 70%. They've built a massive moat in their little corner of the universe, and the crown jewel is that superior, predictable return for their customers. But, of course, you have to look at the other side of the coin. There are definitely risks. This isn't a safe, boring, blue-chip stock. It's what you'd call a higher-risk alpha play. And it lives in the mobile world, which is hyper-competitive and can change on a dime. And that leaves us with the big final question. Does a high-growth, high-performance challenger like this actually have a place in an investor's portfolio right alongside the established titans? Honestly, that is the multi-billion-dollar question that the market is trying to figure out right now. And as always, just a quick reminder, this is for informational purposes only. It is not financial advice. Please, you have to do your own due diligence. Thanks so much for tuning in to Talking Business as Usual. We'll see you next time.